Famous early bubble is this one that people have read quite a bit and written quite a bit about, and it's called tulip mania. And back in Holland, when they were flush with lots of cash from their overseas trading and the invention of modern finance and so forth, they needed a way to basically to lose it, right? So, so they got into the tulip business. And the thing about tulips is that they became very, very, very expensive. In fact, a tulip at one point was worth more than a townhouse, or a couple townhouses even. And I won't bore you with the numbers, but what happened is the value of these tulips plummeted very rapidly. It went back down to earth, and now, of course, you can buy them at the orchard supply for 50 cents a piece, okay? Now, that's not the only one. There's tons of these bubbles, and I love studying these bubbles, and I'll walk you through a couple of them. There was one that happened in England. It's called the South Sea Bubble, and this was really the first IPO. So, we've been doing IPOs for a long time, and we've had IPO bubbles for a long time, and this is actually coined the term bubble, and it's inspired the Bubble Act in England, which banned IPOs for 100 years. Okay, that probably wouldn't go over too well nowadays in Silicon Valley. And you see that the price of the shares of the South Sea Company went way up, and then of course went way down. And you might be thinking, well, who would be dumb enough to buy at the peak of the bubble? Right? Who would be dumb enough to buy? And by the way, this company had basically no business model. Their business was illegal. The rest of the world outlawed what they did, but they were trading slaves to countries that basically would not allow them to trade slaves. And so the price of the stock went way up, and then of course it plummeted. Who would be dumb enough to buy at the peak of the bubble? Dumb people like Sir Isaac Newton, for instance, who lost his entire fortune in the drop. Now, of course, why would Sir Isaac Newton buy at the peak of the bubble? Because he was a big believer in momentum. Right? He actually, believe it or not, he came up with some theories. He invented momentum, right? The problem is that Sir Isaac Newton also, he forgot about this, but he also invented or discovered gravity. And so if he had remembered that part of his theory, he would have avoided the rapid decline thereafter. Okay, now fast forward to recent times. Maybe some of you are old enough to remember the Japanese real estate bubble. When I first started teaching, everybody thought that Japan's going to take over the world. They even bought Pebble Beach. And they bought, Van Gogh paintings and everything. And it was all based on the land value that had inflated back in Tokyo. So back in 1991, the land value in Japan was nearly $20 trillion. So you could, for the same amount of money, either buy the land beneath the Emperor's Palace, which, is a fine piece of real estate, or you could buy Canada. Now, which would you prefer under your Christmas stocking? I'd rather have Canada, right? I mean, what are you going to do here? You walk around, look, it's nice and pretty, but they don't have any oil or anything, or hockey. There's nothing good there. Okay, so what happened is, of course, Japan, they lost all their land value, and Japan has not recovered yet to this day. I mean, they're still mired in this recession for the last 30 years, 20 years. Okay, now, more recently, maybe some of you, this is going to touch a little too close to home, but the dot-com bubble, and just to give you a sense of what happened there, I'm not going to go through all the aggregate details. Anybody remember this company, VA Linux? Anybody have the stock still? Okay. So, this thing opened at $9.5 billion market cap. Now, what's their business? Free software, right? Okay. So, what happened? Well, this is what happened. The stock went from $242 to $7. But the thing is, they were smart enough to keep their burn rate low enough so that they're still in business. Unlike so many of these other dot-coms, they are still in business, except that they don't really do software anymore. They are now called GeekNet. They sell T-shirts, which is actually a more viable business model because at least it has revenue, $2.99 a shirt. So if you want to support VA Linux and boost, the stock price, then you can buy some shirts. Okay, and you guys all know about Webvan. Maybe you guys got sucked up in Webvan. Maybe you got sucked up by Pets.com, right? Maybe you got sucked up by the housing bubble. Okay, so I remember this slide came out in 2006, and I remember talking to people and saying, don't buy a house, don't buy a house. And they're like, but wait, it doubles every 10 years. We've got to buy a house. And of course, that's what happened to houses, except in Berkeley, where they're even more expensive than they were in 2006. Okay, so again, what about the stocks that were inflated by the housing bubble? Like Bear Stearns, Lehman Brothers. These guys completely crashed after all of the inflation of their asset prices in the 2000s. And of course, more recently, poor old Zynga. Okay, it's in the doldrums. Anybody work at Zynga? Okay, all right. They're hiding underneath the chair, playing with Farmville. Okay, so I shouldn't say anything bad about Zynga, but you know that's another one that's kind of collapsed. So you know, how do we understand these bubbles? You know, it's great to be a historian and tell some tall tales and fun stories about, oh, look at those poor Dutch people, look at those poor, you know, Zynga investors. But we can also construct theoretical models, and so financial economists are really good at building out models. Let's assume this, and then add in some calculus, and boom, there's our answer in our paper and our tenure. Another way to do it is to use experiments. So experimental economics is this brand new field. It's not really brand new, it's been around for a while. Within economics, where you try to replicate the techniques of the natural sciences, right? So if you're trying to figure out what makes a rat fat, okay, you know, you stick them in a cage and you force feed them all sorts of things like, you know, McDonald's or whatever, and see if they get fat, right? And then you have a bunch of other rats in another cage, mice, but they're exactly genetically identical, and you feed them, you know, Subway, and you know, see how fat they get, right? And that is the experimental method. And so economics, which has been built around kind of looking at the world, doing empirical stuff, or cooking up all sorts of theories in your office, has now moved in the direction of the natural sciences. And we can do experiments on people to find out what drives their behavior. Okay? And so we actually have a lab here in the building across the way, and it's called the Berkeley Experimental Social Science Lab, or XLab for short. And so what we have is these different cubicles, and people will walk in. Generally, undergrad students do this. MBAs, they basically screw up every experiment, so we ban them. But you know, undergraduates will come in and we'll administer all sorts of experiments on them to find out, you know, what is making them behave in a particular way. So if we can look at something like a bubble and say, oh, you know, we've seen it in practice, but maybe it's not really a bubble. Because if you look ex post and you say, oh, there's no way tulips could have been worth, you know, $10,000 a tulip. But for markets to be efficient, the only thing that has to be true is that the prices have to be consistent with the information set that was available to the people at the time. So, you know, lots of times prices go up and prices go down, and that doesn't mean that there's a bubble. It just means that people get new information and they think everybody's going to buy their pet food online, and then, of course, they realize they're not going to buy their pet food online, and so the stock crashes. That may not be a bubble if it's consistent with the information that the investors had at the time. So the great thing about an experimental setting is that we can control the availability of information to the participants. In other words, we can create a market where the fundamental value of the asset is known to all of the participants, right? If we try to test to see whether or not Zynga really was worth $14 a share, we'd have to have some sense of what the fundamental value was at that time, and we don't know it. So that's the great thing about experiments. So if you're going to set up an experiment that would test for the propensity of people to naturally, among themselves, create bubbles in asset markets, what we could do is create an artificial asset with a value that was known to everybody, and then allow people to trade them amongst themselves within this artificial market. And then at the end, as with all of these experiments, we pay the participants money according to how successful they've been at engaging in the activity. So the traders that make a lot of fictional money in the lab get paid a lot of real money, and the investors that lose a lot of fictional money in the lab wind up, you know, getting paid less money. Okay, so they're incentivized with these compensation schemes. We use real money to pay our you know, victims or, you know, participants in these experiments. Unlike the poor mice who don't get paid, they just get their necks broken when we're done with them. Okay. Unfortunately, we can't. That's why we don't let MBAs into the experiment, because a lot of us will want to break their necks when we're done. So to keep them safe. Okay, so here's the experiment that is sort of the canonical experiment that has been replicated numerous times, and which we have carried out up here in the XLab on a bunch of occasions. And it's actually the guy who invented this experiment. His name is Vernon Smith, and he won the Nobel Prize for inventing experimental economics. And the idea is we create this asset, which has a finite life, and this asset is going to spin off dividends over its lifetime, and then it ceases to exist. Everybody collects their checks, and they leave the experiment, okay? Now, the one thing that kind of makes it a little bit interesting is that the dividend is a random number. the distribution of which is known to all the participants. So if you have even the most basic mathematical ability, and our Haas undergraduates presumably have that, you can figure out what the average or expected dividend will be each period. And in this case, it's going to be 24 units or $24. You're going to get $24 each period. And then the students or participants are given a bunch of cash, and they're given some shares. And if they want to increase their holdings in the shares, they can buy the shares. If they want to decrease their holding of shares, they can sell the shares. And so they're asked to submit bids and asks, through a computer terminal, and then the computer displays, the prices of the assets, the supply, the demand, et cetera, and then, exchange takes place. All right? And then we do it again with the same people to see if they, behave any differently. So here's the asset. It's got 15 periods. It's got a dividend of 24 each period. The experiment only lasts like an hour, so you don't have to do any discounting or present value computations. And so the value of the asset, according to this very simple calculation, is 360, lab dollars. Okay, and that's what it should be trading for in the first period. Now, after we figure out who owns it in the first period, the dividends are distributed to whoever's holding the asset, and then they're allowed to trade again. Now, because the dividend has been paid out and there's only 14 periods left, the second period, it's going to be worth 336 lab dollars, and so on and so forth, right? So the fundamental value of this asset is going to be declining until you get to the final period where the asset has no value left. Okay? So it's worthless. And so the value of the asset at period 16 should be 0. Okay? So we got this whole thing set up, and now we say, trade. Let's trade. And so this is a display. This is sort of what they see. So you have your holdings over here. Okay, you can submit your buy order or your sell order, and anybody who's done any kind of trading understands sort of how this works. And then over here, the offers to sell and the offers to buy are displayed, and then there's a market clearing price at which shares will change hands. Okay? And then you're given a couple minutes to think about it and then decide what to do, et cetera. So what do you suppose happens? What do you suppose happens? Boom, first period. Well, the price is way below the fundamental value. People are looking at those shares, maybe they're a little suspicious. They're like, I don't know whether I really want that. I don't know. I got cash. I don't really know what it's worth. I don't even know if the stock's popular, right? Do you remember this morning's talk? Popular is good, right? So they don't know whether it's popular yet. So they're not quite sure. It's the new kid on the block. They have to size them up, all right? And then, there are some people that look at that and say, ooh, wow, that's pretty cheap. That's a cheap asset. It's worth below its fundamental value. So let's buy it. What do you suppose happens? Price, doesn't really go up much. The volume goes up, and people start to see, ooh, people are getting interested in this market. And then the price goes up a little more next period, and it goes up, and it goes up, and it goes up, and wow, it's now approaching the fundamental value. So at this point, you'd think everybody's figured it out. They've done the math. They know what it's worth. And so at that point, the bargains are now extinguished. The PE is up to its historic high, and now the party's over. But no. Keeps going, right? Now it's trading at more than its fundamental value. Okay, and now maybe this is just a mistake. And people look at that, oh, whoa, we overshot. Maybe, we should get out of this thing before the party, before it ends, before people figure it out. But no, it keeps going up, right? And this happens with the real people, with real money in a real experimental setting. And then it keeps going up a little more, and then it stays up there, and this is people buying and selling this thing at a price that's way above its fundamental value. And then all of a sudden people start saying, what's going on? Maybe we should cash out our positions, lock in our gains. And then the price starts to decline, and then it goes back to the fundamental value. As soon as people see that the game is about to end, they're like, I got to get out of this thing, and they cash out, okay? So this thing right here, this is what we call a bubble. Now, of course, this thing's also interesting. Why do we see these things trading at discounts? But this is what I'm interested in right here, the bubble, okay, where it's traded. Yeah?
So do the undergrads know those fundamental values? Do they have to figure that out?
Well, all they have to do is do the math. So you average the 4 dividends, and you get 24, and then you multiply 24 by 15, and then boom. And we teach them how to do this, okay? Did you take Introduction to finance, dividend discount model, you know, it's like week 1, okay? So, you know, we're assuming these guys, I mean, they're not all Haas undergrads. I mean, we might bring in some English majors, right? But even they wouldn't get into Berkeley if they couldn't multiply, right? Now, you might be thinking, well, what if I, you know, just said, all right, you're getting $24 a period, you got it? You still get a bubble, okay? I mean, you can spell it out as much as you want, and you're going to get a bubble. Now, after this, so, yeah.
Do you tell them 15 periods in advance?
Yes.
So why?
Well, we need to give them a finite, so if you don't have a finite end period, then you don't have the ability to calculate the fundamental value. Right? So we want to make it so that the fundamental value is knowable. Right? So it's not like trading, you know, Zynga stock, where you don't really know. You have to make estimates about earnings and all this other kind of stuff. It's like, we got a $20 bill. How much do you want to pay for it? Okay? We want to make it really easy. Really, really easy, okay? So we get this bubble. Now, you'd think after this, some of the people are going, oh, man, what was I thinking? I can't believe I bought this thing for more than it was worth, you know? And these other people, I can't believe I didn't buy it back when it was cheap. So then we say to them, all right, let's do it again. They're like, okay, this time we'll do it. And this time we'll get it right. So we open up the trading, and what happens? Starts off low again. Nobody really, what's going on? People are timid again. Maybe they're still recovering from the bathroom break. I don't know, but it starts off low, and then it goes up, and then finally they're like, oh, I've seen this tune before. Now I know what's happening. What happens? It keeps going up, right? Now, notice that even though you get a bubble with the second time round, it's a little bit different, right? I mean, it starts a little earlier, it ends a little earlier, it's a little smaller. And so, in some sense, you could say people are a little wiser. I don't know. They've been suckered once. They're not going to get suckered again, but they do get suckered again, but not quite as much. And so we do it again. Let's do it a third time. And then the third time, well, okay, people have learned their lesson. So it seems like twice bitten, 3 times shy. So the bubble kind of goes away when you do it a third time. So what does this say? Well, experience. People learn what's going on. They've been, you know, punished or rewarded based on their experience, and they generally get it after a while if everything's stable. Now, what's really scary about this is that, and we can use this, we can start manipulating liquidity, we can manipulate the order book, we can do all sorts of things to see what institutional conditions will make the bubble smaller or weaker. And it appears, at least based on this version of the experiment, that the one thing that really matters is experience. And so people on Wall Street back in the 60s would say, we're never going to have another bubble like the 30s as long as I'm still working here. And then what happened is those guys retired, and then you get the next bubble. So the idea was that as long as the people who lived through the last bubble are still around, you won't have another bubble. You need a new batch of suckers to get the next bubble. Now and recently we've seen these bubbles come closer and closer back to back, and I think there it's because you're not repeating exactly the same thing. So if we go into this experiment, we just change one thing. So instead of 15 periods, it's 18 periods. Or you change the payoffs, you change the dividends. Or you mix up the people. So you say, okay, you've done it 3 times, that group's done it 3 times, now let's put you guys and you guys together. You get a bubble again. So as soon as you change one thing, and that's maybe why people who lived through the dot-com bubble said, man, there's no way I'm ever going to get suckered into buying equities again. I'm sticking to real estate. Right? So, it got busted again, but, it was something different. So, maybe the people who've got, who blew it in the dot-com bubble will never blow it in another dot-com bubble, but they'll get sucked into some other bubble, the Bitcoin bubble, right? Okay. So experience seems to matter, as you can see. It tends to flatten out these bubbles. Now, what I'm at, yeah? Oh, that's the volume. The volume, so it tells you sort of, how many shares traded, okay? Now, you can repeat this experiment with, I will tell you, I did this with a bunch of financial managers, like financial advisors, and these are, well, actually, I'll show you those, no, I won't show you those results. Financial advisors, I've done this with them. These guys are off the charts in terms of the bubbles that they create. I mean, it is nuts. I mean, I have never seen it. You can do this with undergrads, English majors, you'll get bubbles. Financial advisors, there's no room on the chart. the computer like melted down because the price, it wouldn't support prices that high. Yeah.
Can I ask two questions in a small deviation? One is, do you think the Fed is looking at any of this? Because there seems to be, you know, and number two is, it's related to question number one, but in your work post the bubbles, does it affect their future buying behavior, right? Because one of the things we see from these bubbles is that the economy tanks, even though the dot-com bubble blew up, right? There's a spillover effect.
Well, yeah, of course. So, you know, if it was just like, oh, that was fun, we had a bubble, no big deal. But of course, what it does is it has long-lasting effects, in particular on institutions that have been, you know, suffered through the bubble. So the balance sheet of the Japanese banks, the zombie banks, you know, is still weighing down the Japanese economy. You know, people tend to become more timid and take fewer risks. So my colleague Ulrika Malmandir has done studies on investor behavior on people who've lived through crises and bubbles. They change their investment behavior going forward dramatically, right? Because they take on fewer risks. And so, you know, that's one of the reasons why the Fed is very aware of how recessions can sort of perpetuate themselves because people are unwilling to spend or unwilling to take risks. And so this has been part of macroeconomics for a long time, but it hasn't been grounded in the micro study of asset pricing and how asset prices work. So I think the Fed is very much aware of this, and they do pay attention to this. Okay, so what I'm interested in talking about today is, well, what can you do about this, right? How do you make money from this? So if we go back to this picture, we look at the prices. You know, if you followed the Warren Buffett rule, which is buy when the stock is below fundamental value and then sell when it's above fundamental value, what would you have done here? You would have bought right here, okay, and then you would have held on, and then you would have sold the minute this thing penetrated the fundamental barrier, right? As soon as it trades for a penny above fundamentals, you're out, okay? Now, that guy would have done better than the people, you know, who had bought into the bubble, certainly. Couldn't you do even better? How could you do even better? Selling up here. In other words, holding on after the asset goes past its fundamental value. You can do even better than the basic fundamental guy. So I have a lot of friends that work in hedge funds, and this is what they're trying to do. You know, they're like, fundamentals, yeah, you know, that's important. I got to know about that, of course. But I'm really interested in how other people behave. I'm interested in what the market thinks, right? Where's the market going? You know, what does the investor do? What are the other strategies out there that are driving prices? Okay, so in order to understand investor behavior in aggregate, we need to have some game theory. So game theory is another course that I teach, and it's a lot of fun. And usually game theory is applied to things like industrial organization and labor markets and pricing, and rarely is game theory applied to finance. And so that's sort of what I'm interested in doing. So if you remember or have encountered any game theory, there are a couple very classic games. They're simple 2x2 games where you have two players, each of whom has two strategies, and then you can depict it in a 2x2 box. And so if you've heard of game theory at all, you've heard of prisoner's dilemma. Okay, now I'm not going to talk about prisoner's dilemma. I'm going to talk about these other two games. One's called Stag and Hare, which is a cooperation game, and the other one is a hawk and dove game. And then if you follow me as I work through these games in their basic form, I'll try to explain how they help you to structure your thoughts about interactions in financial markets, okay? We teach game theory in our strategy classes. It's a key part of strategy. So here's the hypothetical. Suppose you're going out hunting. Does anybody hunt here? When I was in Virginia and I asked people hunt, people were like, and you know, here it's like, hunt? Are you kidding me? You know, like, you know, tofu doesn't move. Why would I want to hunt it, right? So if you're hunting for stag essentially is a two-man job. You need two people to hunt the stag. Essentially, you got to corner the stag. And you see them actually wandering around campus late at night. But you need two people, basically. You need one guy to kind of shoot the stag, and then when the stag starts running off into the woods, you got to have another guy at the other side to shoot him again, right, so that he'll drop dead. You need two people. You got to trap this thing, all right? So it requires cooperation. Now, the other alternative is to hunt hare. A hare is a one-man job. You know, you just chase after it, and then you get it, and then you eat it, okay? So the question that, I mean, I've never done it, so I'm sure it's more complicated than that, but it's basically a one-man job. And so the classic cooperation game that I'm describing looks like this. Now, what is this saying? This says that if you have two hunters and they each decide to go after hare, in other words, they each operate on their own in isolation, they will each get 2 pounds of meat, okay? If they cooperate and they corner the stag and they eat the stag, then they'll each get 4 pounds of meat because it's a much bigger beast. Okay, now, if one of these guys stands in his station doing his part to kill the stag, while the other guy at the other end of the meadow is chasing after hare, then the stag guy will get nothing because the stag will escape. The hare guy will get his 2 pounds of meat. Okay? So which is best for everybody as a whole? What's the social optimum here? It's the cooperative equilibrium where both of them go after stag. They both fill their bellies and enjoy themselves. But what's the equilibrium? What's the equilibrium? So the equilibrium is where, you know, the parties are content with what they have and no one has any incentive to deviate. So this is something called the Nash equilibrium. It's the most it's basic fundamental concept in game theory. So look, this is not an equilibrium because if I go after the hare and get 2 and you go after the stag and get 0, I'm going to think, boy, I should have done the stag. If he's doing stag, I should have done stag. Then we both would have gotten 4. The other guy who got 0 says he did hare. I should have done hare. If I had the opportunity to go back and change my choice, I'd switch to hare. So if you find yourself in this box, what's going to happen is, you know, one of the parties is going to switch when they find out what the other guy did. Okay? And so if both of them are going after hare, then that's an equilibrium because neither party has an incentive to switch. Because if you switch out of it, then you wind up with nothing. Stag-stag is an equilibrium because once you both have the big, you know, stag pinned down, there's no incentive for you to go after hare because then it would reduce your pay. So these two are both equilibria. The question then is, how do you wind up in this equilibrium? So imagine the following. You know, you are going into a hunting lodge in Palo Alto. They've got all sorts of hunting apps, right? And so, you know, you're looking around and say, hey, anybody want to go hunting with me? Okay, so do you want to go hunting with him? Sure. Okay, so the two of you guys are going to go hunting. Now, I want to hear your conversation, because if you decide to go stag, you're going to have to go to opposite ends of Sand Hill Road, and you won't see one another. So let me hear this conversation. Okay, so then you're both going to do the stag, right? Okay, so you grab your guns and you go in opposite directions. Now he's over somewhere on the other side of Sand Hill Road. You can't see him. What's going through your head? Hey, there's a VC right down the street. Let's hunt VC. No. What's going through your head?
I can't see him. I don't know what he's doing.
So what are you going to do?
I'm going to use local information, something I see, and if I see a hare, I might switch.
You might switch. So in other words, your payoff to going after hare is 2. What's your payoff to going after stag? It's going to be either 0 or 4, depending on what you think he's going to do. So you're going to say, what's the probability that he's going to go after stag? Now, if that probability is greater than 0.5, then you'll stick to your end of the bargain. But if your estimate of his reliability drops down below 0.5, then you're going to be like, there's a hare. I'm going to go after a hare. Okay, so how would you figure out what the probability is of him actually living up to his end of the bargain? There's no, you're out of cell phone range, man.
Well, during the event, I don't have much information, right?
That's right. No information.
So it would be based on an earlier personality judgment.
Personality judgment. So let's suppose that Gordon appears to be extraordinarily reliable. You know, you checked his Yelp ratings. They're real good, you know, and Gordon's a great guy, really reliable guy. So you're thinking, okay, I can depend on him. But that's not all that matters. Because what also matters is, well, what does Gordon think of you? because your estimate of his probability of sticking around is going to depend on what you think his estimate is of you sticking around. So maybe Gordon's a really reliable guy, but he doesn't know that you're a reliable guy because he looks up your Yelp rating and there's nothing there. Your clout score is 0. Okay, do you know what that is? Yeah, okay, good. So you have to think not only about what he's like, but you have to think about what he thinks you're like. Now maybe he knows that you're reliable, but he doesn't know that you know he's reliable.
And not only that, I have to know that his judgment his reasoning is good.
Yeah. Well, he has to understand game theory, right? But look, here's the important thing. You have to think about what he thinks, but you also have to think about what he thinks you're thinking, which of course means that you have to think about what he thinks you think, he thinks you think, he thinks you think, he thinks you think, all the way down ad infinitum. Now, it started as a very simple computational task, which is bigger, 2 or the weighted average of 4 and 0. But now you can see that this is a very complex task, right? Psychologically and mathematically even. And so, what you do is going to depend a lot on your beliefs, not only about him, but your beliefs about his beliefs, about your beliefs, about his beliefs, and so on and so forth. Okay, so it's a very, very complicated thing to get to one or the other of these solutions. And you may wind up, anywhere really in these 4 boxes if these individuals are left to decide on their own what to do. Now, in the back of your head, I want you to think about what is the relevance of this to finance and trading and et cetera. So think about that for a second. We will get back to it. Now, there's another way that you could think about this. That's sort of the classic economic way of thinking about this problem. The other way of thinking about it is the way biologists think about it. So I taught a biology course once, which was a lot of fun because I didn't actually ever take a class in biology. But it didn't matter because biology and economics are really sort of the same thing. They're isomorphic mathematically in many ways. And so in biology, the way they learn to think about game theory is they think about not like what's going through your head or what's going through your head. What they do is say, let's imagine we have 2 organisms who don't think. They just do. And they do what their genes tell them to do. Okay? And then we throw them together and have them interact and see what happens. So suppose we have a petri dish, and we have a whole bunch of hardwired stag hunters and a whole bunch of hardwired hare hunters. We throw them into this petri dish. They interact with one another in a random fashion, and each time they interact, they get a payoff. They either get 4 or 0 or 2. And if they get 4, well, then they have a lot of offspring, and these offspring inherit whatever characteristic they exhibit. So if they're hare hunters and they have 4 offspring, well, they can't, they'll have 2 offspring, then those 2 will be hare hunters. If you're a stag hunter and you have 4 offspring, well, those 4 will be stag hunters. So these numbers represent sort of your offspring in a fitness model in biology. Now what happens? Now we can solve for the equilibria because your payoff now depends not just on your type, but what the ecology of types looks like. So if I'm a hare hunter, I'm going to get a payoff of 2 regardless of the distribution of the population. I just get 2, 2, 2, 2, 2, 2. The stag hunters, their payoff is going to depend on how many stag hunters there are. So if I'm a stag hunter in a world of hare hunters, everyone's running around, I go hungry. I get 0. But if I'm a stag hunter in a world of stag hunters, I get 4 every time I go hunting. So what's the equilibrium? Imagine we just do this. We create an artificial society, and I'll show you an example of this, and we just allow them to reproduce. Well, in this world here, where we start off, our starting point is with less than 50% stag hunters, what will happen is the stag hunters will do worse than the hare hunters, and they'll go extinct. But if our initial condition is with 51% stag hunters, the stag hunters will do better than the hare hunters, and the hare hunters will go extinct. Right? So the starting point, the original distribution of the population will determine the outcome. Okay, now where do we see this, right, in life? Well, we see it in standards wars, right? So if you're trying, network externalities it's referred to, right? So if you're trying to figure out how valuable is it that you're operating in the Windows world, well, it really depends on how many other people are using Windows. If I'm the only guy using Windows in a world of Unix, well, all my documents and everything else are totally worthless. If I'm the lone Unix guy, and I don't do Unix, I got Unix, right? But I'm surrounded by a bunch of Windows people, well then, my documents are worthless. So in order to, we're going to see a tendency within standards to have a single standard. Right? You can think about in all sorts of other areas of life. Suppose you have railroad tracks that are 4 feet wide. You're like, I got the 3-foot wide train. You're not going anywhere. Except Spain, I guess. Right? So we're going to see a push towards one or the other. And that's why, of course, a lot of companies that are participating in standards wars try to gain market share as fast as they can so that they can dominate the space. Where else do we see it? So whether you drive on the left side of the road or the right side of the road, this is essentially a game of stag and hare. If you drive on the left side in a world where everybody drives on the right side, you're not going to last long. You're not going to have a lot of offspring. So historical conditions will dictate whether you go all left or all right. So most of the world is pretty much on the right side. There's some chunk of the world that was colonized by England, which goes on the left side. And of course, there's India, where you just drive whichever way you feel like driving. Jury's still out, right? Now, interestingly, actually, Samoa, Western Samoa just switched from driving on the right side to driving on the left side. How does that happen? That's crazy, right? So they did. You almost never see switches. Sweden switched back in the 60s. It's really, really bizarre. Sweden actually was thinking of switching. They said this is a really dramatic transformation, so we're going to phase it in. But that got shot down. Okay, so it was like midnight. Everybody had to switch sides. Okay, so all right. So let me tell you a second game. Does everybody get this game, right? It's called, you see it everywhere. It's called a coordination game or stag. And the key thing is you want to do what everybody else is doing. So you have to look around and say, what is everybody else doing? Okay, that's what I'm doing. So if everybody else is buying the asset, maybe I want to buy the asset, okay? So herding, for instance, is going to look like one of these coordination games. Okay, now the second game I want to tell you about, and I'm only going to tell you about 2 games, is this other one. It's called Hawk and Dove. And it's going to work very different. And so when you learn these games in game theory, you can walk around the world and see things. Like you walk into a restaurant, oh man, there's a game of chicken going on there over at that table. And then, oh, there's some prisoner's dilemma happening over there. And it kind of gives you the frameworks and structures to analyze the world in its more detailed form. So here's how Hawk and Dove works. You got these birds, okay, and they're in dyads. So you see 2 birds, and the 2 birds are approaching a pile of food. All right, now the food is, whatever they eat, worms, I don't know, whatever birds eat. So they're approaching the pile of worms, and they have a choice. Should they be a hawk, which means they come in all aggressive, their talons out, their beak out, or should they be doves and they just go in and be nice? And so here are the payoffs to this interaction. It's going to work very similarly to the ones I just described. If you have a pile of worms with a value v, and 2 doves approach the pile of worms, they will split it peacefully. They'll be like, oh, you take half, I'll take half, great. And they swap business cards. They bump one another. Do people still bump? I don't remember. But this presumably is what would happen if 2 Haas grads were fighting over the same deal, right? They would just split it 50-50. Now, if a hawk approaches a dove, the hawk goes, rah, and the dove's like, I'm out, right? He's going to take off and leave the entire pile of worms to the hawk. But if 2 hawks come together, okay, they're going to ultimately wind up splitting the pie because they're equally matched. But in the process, they're going to wind up paying a price. And that price is W. So you can think of W as the size of the pile shrinks while they're fighting. So maybe the worms are escaping. Okay, that could be like wastage. Or it could be wounding. So there's blood loss. So they fight, and then each one has a 50% chance of winning, but they have to go back and lick their wounds. Okay? So now, what's better in this game? Is there an equilibrium, right? It's clear, I think that the social welfare maximizing equilibrium would be one of these three, because there's no wastage. But what's the equilibrium here? Now, if W is trivial, then it makes sense to be a hawk under all circumstances. But if W is large enough, you have to think twice before fighting. And so what's going to happen is, if W is large enough, your optimal strategy would be, if you see a hawk coming, be a dove, rather than suffer the consequences of a fight. If you see a dove coming, be a hawk, and then you get the entirety of the pie. Now remember, this only works when W is really big. So I mean, think France and Germany, World War I. You know, they fight. There's 10 million dead people, and they're like, okay, let's just, you know, neither one of us gets Belgium, okay? Or, you know, Iraq and Iran. I mean, they just fought, and you know, everyone just went back to the original status quo, but there were millions of dead people, okay? So that would be the hawk strategy. If that's sufficiently painful, then you're going to want to do not what the other guy is doing, but what the opposite of what the other guy is doing. And we could show this using the evolutionary logic, and it would look something like this. If you're in a world of doves, every dove is getting half the pie from each interaction. Now, if you inject a hawk into this, if you take a hawk and you plant them in the middle of the sea of doves, okay, they're just going to go crazy. I mean, this is going to be like taking a hardened criminal from San Quentin and sending him to Walnut Creek. You know what I mean? They're going to do really, really well, okay? And so they're going to reproduce like mad, and the proportion of hawks in this society will increase, okay? Because they're going to win all these battles. Now, let's go over to the other extreme end, where you have a war of all against all, right? Where everybody's fighting tooth and nail, trying to kill one another. And then you inject, you know, Mahatma Gandhi in there. And he's just, I'm not fighting. Oh, there's some food. Okay, I'm going to get the food. And then, boom, he's going to do better than these other guys who are knocking each other silly. And so what will happen is, in a world of hawks, the doves will do well. And what will happen is, regardless of where you start off, you will converge on an equilibrium where hawks and doves do equally well. They both get the same payoff. Now, this is what's called a frequency-dependent strategy, and it leads to here what's called, so it's really evolutionarily stable, these strategies, when they exist in these proportions. Theorists also call this a mixed strategy. You see mixed strategy in sports. So where do we see these kinds of strategies where the goal is to, you know, mix up what you're doing? Well, let me give you one of my favorite examples from nature, because you see this in nature all the time. By the way, the proportion of male and female offspring is a mixed strategy, is a mixed strategy equilibrium. You have a 50% chance of boys, 50% chance of girls, approximately. That's because if you had a world of boys, it would be great to be a girl. And if you had a world of girls, it would be great to be a boy in terms of, you know, offspring. So does anybody know how salmon reproduce? Anybody here fish for salmon? No? Okay, well, you know about dams and all. Where do they do? Where do they go? What happens? This sounds, apart from the running upstream past all the dams and the fishermen, once you get to the top, it sounds like a Harlequin romance novel that you're describing. Okay? It's not that pretty. I'm sorry. That's a after-school special. What happens is, after these salmon make it up through the rapids, over the waterfalls, past the fishermen, past the bear, you know, they think that they have the end in sight where they can get romantic. But that's not what happens. That's when the hard part begins. That's when they start fighting. Oh. What's going on here? I'm supposed to be plugged in. Let me try that again. Try that again. This is what they do. This is not a Harlequin romance. These are male salmon fighting with one another. Okay? Why are they fighting with one another? What's the point of all the fighting? They're fighting for real estate. Okay? Why are they fighting for real estate? They want to what? They want to be daddy, that's right. So what happens is the female salmon, when they get up there, they got to lay their eggs. Now, where are you going to lay your eggs if you're a female salmon? Where? Yeah, you want to find some nooks and crannies to protect your eggs from all the predators. So if you're a male salmon and you want to reproduce, you're going to locate yourself right by the nooks and crannies. But all the other male salmon want to go by the nooks and crannies, and so they fight for who gets, you know, it's actually like, have you ever tried to buy a house in Berkeley? It's kind of like that, okay? It's real estate, right? So people are, these male salmon are fighting over one another. Now, if you know that these male salmon are beating the living crap out of one another for this real estate, maybe there's an alternative strategy as a male salmon that you can use to reproduce. What might that be? Or think about it another way. If you were a parent of a young male salmon, would you want your young male salmon to grow up to be big and strong? Of course you would. Except, maybe you don't. And it turns out that if you have male salmon that are big and bruisers and they're fighting one another, it might actually pay to be a little tiny, sneaky, slippery salmon. Because while these males are fighting and duking it out, the little slippery salmon slips in, fertilizes the eggs, and slips out. Right? And the male salmon, they're fighting, and they're like, what was that? Oh, geez, he's gone. Oh. And then they go back to fighting, right? So in a world of male salmon, it actually pays to be a little tiny salmon. But if you have too many little tiny salmon, then a big salmon, if he jumps in, he can guard his territory. He's got nobody to fight. He can just spend his time warding off the little baby salmon. So in fact, right, this is a frequency-dependent strategy. And if you look at salmon, there's actually this dimorphism where you have big salmon and little salmon, and it's a stable equilibrium where the proportion of small salmon is sort of constant. And small salmon don't beget small salmon, large salmon don't beget large salmon. Rather, you know, you have offspring salmon, and there's a probability associated with like male and female. Okay, now where else do we see this? We see it in sports. So if you're taking a penalty kick, where are you going to aim it? Left or right? Who says right? Well, maybe because you see what that guy's doing. But look, the way it works with penalty kicks is when the guy kicks the ball, he doesn't know which way the goalie's going to go. And when the goalie jumps left or right, he doesn't know which way the ball's going to go. So you have to actually decide simultaneously if you want to have any chance of defending the ball. So if some kicker's like, man, I'm much better shooting to the left. I'm just going to always shoot to the left. He starts shooting the left. The other guy, the goalie's going to be, oh, that's the left guy. And he's going to run in and defend the left. Or if you're the goalie and you're like, I always go right, then the shooter's going to always shoot left. So you actually have to pick a mix. It has to be random, right? Just like with football, you know, you're going to do a pass or a run. You have to keep the other side guessing all the time. Even if you're better at passing than running, you have to run occasionally to get them off guard. Okay, so this is actually, you can solve this mathematically. And you know, what you have to have is you have an internal randomizer, because if you show any predictability, then the other guy will be able to defend. So you need one of these inside your brain somehow. Maybe Google Glass. Maybe the football players will be using Google Glass soon. So there was actually an economist, and I mean, what else? What can't you do research on, right? So you know, if you want, you should always take a look at all the fun research that Haas is sponsoring. This is not Haas, but these guys went out and this guy went out and looked at football players, you know, European football players, and he found that based on the probability of success that these guys had, they were playing almost perfectly. They're randomizing, both the goalies and the shooters were randomizing almost perfectly, even though none of them know anything about game theory, presumably. Okay, they just fell into the social optimum. Okay? Now, there are some other sports where it doesn't happen, actually. So in baseball, you know, if you throw fastballs every time, then you're going to give up a lot of hits. So you got to mix in some off-speed pitches. So according to this study, there's actually too many fastballs, and these guys switch back and forth with too much predictability. And so, you know, I have a lot of students that work with people in Major League Baseball and other, we do research in this area. We have MBA students now that all want to go into sports management. They're using analytics, and they came in second place in the sports analytics competition that was sponsored by the NFL last year. Okay, and so another result is that there's not enough passing, too much running in football. Okay, now where do we see this in real life? This is a problem that a lot of you may have encountered. I certainly run into this problem. If I'm in Berkeley and I need to get down to Palo Alto, okay, I've got 3 possible routes. I can go across the Bay Bridge, San Mateo Bridge, or the Dumbarton Bridge. Okay? Now, if you look at, if on average, these 3 routes take almost, if there's no traffic, all 3 of them take exactly the same amount of time, really. There's no reason to take one or the other, except for, you know, and they all have the same tolls as well. So there's really no reason to pick one or the other. But when Google invented, you know, Google Maps, or before that, you know, you could get real traffic updates from other sources, and you could look at this. What would you do if you saw this map? So I'm sitting in Berkeley, I'm like, which route should I take? I go look at this app, and I go, oh, man, I'm going to go take the Dumbarton. Now, does that make sense? Is that right?
Only if everybody else isn't looking at the map.
That's right. So if you're the only one with Google Maps, then you can take Dumbarton, and you're probably going to be in the clear. But if everybody else is looking at Google Maps, then everybody else is going to go on the Dumbarton, right? So you might actually be better off taking the Bay Bridge. Even if it's like, you know, there's an accident on the Bay Bridge. Maybe, you know, if no one goes there, then you'll be the only guy and you can get around the accident. But then again, right, those other people who have Google Maps are wondering what you're going to do. And they're saying, well, wait a second. If the Dumbarton Bridge is green, then everybody's going to go to the Dumbarton Bridge. But wait a second, everybody's going to figure out that everybody's going to the Dumbarton, so nobody's going to go to the Dumbarton. So maybe I should go on the Dumbarton. So you need to actually, you can't just look at this. This map doesn't help you. Right? You need to know not only the state of the roads, but what is the state of the cognition of the other people out there? How many people are looking at this? And then what are they doing? What's their strategy? Right? What are they guessing? It's back to the stag and hare. I need to know, what does that guy think I'm going to do? What does he think I think he's going to do? Right? What does he think I think he thinks, I think you think, everybody thinks everybody else is going to do? And, you know, this becomes an extraordinarily difficult problem in a world where everybody has access to Google Maps. So when it was just a select few, it was great. But now everybody has it. And it would be better if we just said, Google, just tell me where to go. And then Google would assign, you go that way, you go that way, you go that way, right? And if we all followed Google's logic, then we would maximize traffic flow. I mean, that's the idea, right? So you know, the problem with some of these models is that we can mathematically compute what the optimal routing distribution should be and what the optimal mixed strategy is, but we don't always get to equilibrium. So if we have a world with say, predators and prey, and they're coexisting, we might think that, you know, if there's too many predators, then the prey disappear. And if there's, you know, too few prey, then the predators disappear. And so when the predators increase their population, then the prey will go down. And so you might think that the predator and the prey would think through this problem. They would work out the optimal equilibrium. You'd have a nice steady ecology with neither too few nor too little predators and prey. Everything would be good. It's kind of like old MacDonald's farm. The problem is that there's a delay in the feedback. Right? So if we start with a lot of hares, then the lynxes here, who are predators, will multiply, but they multiply more slowly than the hares. And then as the lynx population expands, the hare population will crash. And then, right, these guys will crash a little later. And so you see that there's this constant oscillation in predator-prey models where the populations are expanding and contracting, you know, with this rhythmic regularity. Okay, so there's not a steady equilibrium. Now, you also see this on the freeway. So, you know, suppose you're in the left lane and the right lane is zooming past you. Right? What do? Swear, yeah, you go into the right lane. But then, of course, then the right lane becomes the slow lane, and then you turn around the left lane, you go back to the left lane, right? And you never actually see the lanes sort of smoothing out. You just constantly see this oscillation. And, you know, there are people that study this, and that you can watch it on video, okay? So now let's get back to finance and think about, you know, you have two strategies as an investor. And I don't mean like as an ordinary investor. I mean sort of as a professional investor. One of which is passive, you know, where you just put all your money in an index and you just say, okay, you know, the prices are right. I'm just going to work on asset allocation. I'm just going to focus on covariances and correlations, get mean variance efficient investing. That's all I do. I don't look at balance sheets or income statements or any of that kind of stuff. Okay, and there's a lot of investment professionals that advocate that approach. Versus another approach, which is, you know, I'm going to look at all this information and data, and I'm going to do research, and I'm going to look at balance sheets and income statements, and I'm going to make phone calls and all this kind of stuff. And I know people who live in both worlds. Now the question is, which is better? So suppose that investment research is costly. You know, you got to spend a lot of time deep in the weeds, looking through financials, doing, you know, value-added research. Are you going to waste your time doing it? No, because on average, we know that the average investor does worse than the index investor. So let's all put our money in the index. Now, what happens when everybody puts their money in the index? When everybody puts their money in the index, well, nobody's doing any research. So they're like, Enron, that's 2% of the market. Let's make sure 2% of our money's in Enron, right? And then nobody ever finds out that Enron's just a big fraud, right? Because no one's actually doing any work. So look, in a world where everybody's active and everybody's doing research and everybody's doing research to uncover underpriced and overpriced securities, it's best for you just to kick back and say, you guys are, you know, doing a great job. Thank you very much for the research. I'm just going to free ride on all of it with my index fund, and thanks for everything. I'm paying my 1/10 of 1% management fee. We're good. But if everybody does that, then it pays to be an active investor, to uncover underpriced and overpriced assets. So this is frequency dependent. This is a hawk and dove game. And so in order to know what is the optimal strategy, you need to know what the other guys are doing. What's the distribution of investment philosophies and strategies within this market? So that's why professional investors spend at least as much time trying to figure out what the other investors are doing as they do focusing on, right, the assets that they invest in.
But isn't that mostly unknowable?
Yes, of course it's unknowable in the same way that it's unknowable what the heck Gordon thinks about you over on the other side of the you know, Sand Hill Road. Or it's impossible to know, right, what the other drivers are doing. So, and especially because they don't necessarily want you to know what they're doing. That makes it even more difficult. Have you ever tried to pry out of, you know, a hedge fund manager what they're doing? I mean, it's very difficult, unless, of course, they want you to know, in which case you can't rely on what they're telling you. Okay? So, look, in order to know whether or not you're going to flourish, you need to know what the ecosystem looks like. So, you know, if you're a dodo bird, you're like, am I going to flourish in New Zealand? Well, if there's no humans, yeah. But if there's humans, right? You're going to be the original, you know, McNugget, the dodo McNugget. Okay, so we actually have some tools that we can use to explore the interaction of different strategies. So this is something which it's called agent-based modeling, and I'm going to show you a very simple version of this. So here we have hawks and doves. We start off with a population that's equally distributed between hawks and doves, and then we watch them go at it. And you see that the hawks pretty much put the doves out of business when fighting is cheap and free. So now let's increase the cost of fighting, make fighting really painful. We'll start the whole thing all over again. And now watch what happens. We get a nice steady interaction, right? Stable equilibrium between hawks and doves. Then we could throw in another strategy just for fun. Let's call this retaliators. So retaliators are people who, they retaliate against the hawks, but that costs them something. Now what happens? The retaliators will initially keep the hawks, wait, let me start with the cost down. Okay, but with retaliators, what happens initially is the retaliators do really well, and they keep the hawks at bay. Okay? Well, this time it happened one way. But then what happens is the retaliators, because they're actually incurring lots of costs, start losing ground to the doves who don't pay for this. And then we could actually the hawks are extinct here, but we could introduce a mutation rate. And if we introduce a mutation rate, then the hawks will come back to life and put everybody out of business. Okay? So we can play with the mutation rate. We can also introduce learning. So learning would be imitate the other guy. And then we see other dynamics. So if you want to know what an optimal investment strategy is, you need to know what the other guys are doing. Okay, so now when we go back to a bubble, for instance, what's the optimal investment strategy in a bubble? Well, before we get that, has anybody seen this? There was something that happened recently with, there was a news report that was false, that Obama was, that the White House was, and there was a little flash crash. So look, what happens with this flash crash? This is United Airlines. There was a Yahoo News error which said that United was going through bankruptcy. And it was a coding error in the news. And look what happened to United stock. Now, why did this happen? Because you have a program trade which is reading the news, and it sees bankruptcy United, and then in order to be the first one to sell, it initiates a sell. So it goes down by a little bit. Now, that's not what caused it, because then there are other programs that say, if the price goes down by 2%, sell. Now, then you got a bunch of other guys who are saying, if it goes down by 5%, sell. You got another one saying, if it goes down by 20%, sell. And so what happens, each of these programs cause the other programs to kick in. And the stock price plummets. And then what happens? Well, then you got some other guys, if the stock price goes down by 60%, buy. And then you got another one that says, if it goes up by 10% in 5 minutes, buy. And then it goes, doo-doo-doo-doo. Before any human beings even figured anything out, right now you're back to square one. Okay, so what happened? Here, what's going on? This would not happen with a different universe of programs. Right, so it's only purely the universe of programs that caused this to behave this way. So before you put in place a program which says, sell if it's gone down by 20%, you need to know, well, are there other guys who are going to say, sell, 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 sell if it goes down by 20%? Because then, you're going to lose even more, right? So you need to know what the other guys are doing. So I have this experiment I'm not going to do. So let's go back to the dot-com bubble and just say, well, what did the hedge funds do? The hedge funds are supposed to be the smart money. It's the idiot retail investor who bought pets.com, and the hedge funds, the smart guys, they're the ones that are supposed to be sitting on the opposite side of the trade saying, oh man, this thing's overpriced, I'm selling. Turns out the hedge funds were long the bubble. The smart money was long the bubble. Not just the retail dummies. Now, are they being stupid and getting sucked into the same idiocy of the retail investor, or are they savvy saying, I'm going to surf on the sea of irrationality out there and get out in time? Well, so these are two of the most famous hedge fund managers in history, George Soros and Julian Robertson. And they experienced the bubble together, and they had alternative philosophies. Julian Robertson said, the bubble is ridiculous, I'm going to short the bubble. And George Soros said, nah, I'm riding the bubble. I don't care about fundamentals. All I care about is where's the market going. And what happened? Well, Julian Robertson, who was probably the most famous hedge fund manager in history, lost more money for his investors in 1999 than he had made throughout his entire career up until that point. Of course, he still has a few billion himself, but what happened? He was wrong. He was right. Tech was overpriced. But that didn't prevent it from continuing to go up even further. So as a fundamental investor, he lost his shirt because he wasn't thinking about the behavior of others. Soros is still in business. He's still around. He's still doing fine. So what's happening? People tend to, right, people tend to look around and see what other people are doing. It's called herding. Okay, if the market's going up, they plow money into the market. If the market's going down, they pull money out of the market. And so as a result, investors do very poorly. They don't understand their behavior. They don't understand why they do what they do. Right? They're not thinking about the ecology of strategies in the way a professional investor thinks about the ecology of strategies. And so I'll conclude by pointing out this is an important debate that's arisen recently about whether or not hedge funds actually add any value. And if you look at the industry numbers, you see that hedge funds have done better than stocks, bonds, commodities, with a lower standard deviation, pretty much, than most of them. They've got the best Sharpe ratio, which says hedge funds are the best asset class that you can invest in, essentially. But what this ignores is the fact that, right, this is all time-weighted. If you look at dollar-weighted, when did people invest in the hedge funds? When the hedge funds were going up and up and up and up and up, there really weren't all that many people invested. Until 2006, 2007, everybody's like, man, I got to get into the hedge funds. Those hedge funds are doing great. So everybody puts all their money in the hedge funds. And then you have 2008. So the net result is, regardless of these numbers here, more money has been lost by investors in hedge funds than has been made. Okay, and so there's this book that went out a 2 years ago called The Hedge Fund Mirage, and it basically says that if you took all the money that was invested in hedge funds, right, in the last 20 years, and you put it in T-bills, you would have done twice as well, twice as good. Okay, so now that's the problem. So the hedge fund industry responded by saying, well, look, that's not our fault. We do well. It's the investor's fault for investing at the wrong time. Right? We're not going to say no to money when everything's overpriced. If you give it to us, we'll take it. And so really, the problem is one of behavior. So the key question that I keep coming back to in my behavioral finance class and also in my game theory classes, when does it pay to stick with the herd? Right? When does it pay to do what everybody else is doing? And when does it pay to do the opposite of what everybody else is doing? When does it pay to stick with the herd, and when does it pay to deviate from the herd? And I think that's a big part of behavioral finance, and I really enjoy talking about it, talking to investors, talking to investment advisors, talking to hedge fund managers, talking to corporations, talking to pension funds about these issues and questions. And if anybody's in that industry, and wants to talk about it with me, I'm really glad to talk about it. And my email is, available on the website. And I think our time is up. But if any of you guys have questions, I don't know. We started a few minutes late. Do we have time for one question, or do you want to just call it quits? What do you think? Question. No, I know, but you want to bring up a question?
Yeah, I'll bring the mic over.
So there's two herds I see behaving interestingly right now. One is around Apple, and one is around gold. Do you have any thoughts about those?
That's a good question. So yeah, I think there's definitely. I'll say I think that there's been a gold bubble, and part of it is brought on by the ease of investing in gold, right? So the creation of gold ETFs. Another very easy, easy to invest in vehicles. I have some other slides on John Paulson in particular, who I, admire for his greatest trade ever, and he has done really poorly ever since. He lost a ton of money in financials in 2011. He lost at Sino Forest. A guy who's a research-based guy, like not doing his research on that, and then gold. The guy's lost almost $1 billion, I think, on gold, which is a rounding error for him, of course. But yeah, so the gold I'm very skeptical of. Apple, well, I would have told you when it was at 700 that I think, yeah, there's an Apple bubble going on. But right now, I really don't know enough about the fundamentals to know anything. What I do know is that products like that, companies like that, have a lot of retail interest. Peter Lynch once said, trade what you know. And so if you use an Apple, you buy an Apple, right? If you're a Pac Bell customer, right, back in the day, you would buy Pac Bell and not Bell South. And so, there's some value to that where people will inject their information. The problem is that then, these retail investors who understand the product but don't understand the financials can cause a lot of volatility in the price, which cannot be arbitraged away by the institutions. So, so I think, you have to be very careful about some of these companies that everyone thinks they know something about. The prices may not reflect the fundamentals very accurately. Yeah, last question. Oh, that's a good question. So I actually asked a hedge fund friend of mine recently about, how he says when the bloom is off the rose, that's when you sell. I was like, can I turn that into a program trade? He was like, no, I'm not telling you. So yeah, I mean, I think that that's a very, I don't know. If I knew the exact way to figure that out, then I would be a billionaire. But I do think that with bubbles, when you start running into people in the street, taxi cab drivers, right? Well, I guess they're not in the street; they're in the car. But taxi cab drivers and ordinary folks, when your nephew or grandmother or whatever thinks, oh, I found the best way to make money, that's the time to get out. Okay? So when people start flipping apartments in Las Vegas, you don't know anything about, you've never been to Las Vegas, that's the time to get out of Las Vegas real estate. E-Trade actually had a really funny commercial back in 1999 because there was a quote from this economist back in the 30s who said, when your beautician or hairdresser tells you what stocks to buy, that's the time to get out of the market. And so in E-Trade in 1999, they actually had a television ad where this business person goes in to get his hair done, and the guy's like, you got to buy this stock. And he's like, great. And he runs back to his office and buys it on E-Trade. And I was like, whoever is at that ad agency has a tremendous sense of humor. And they're basically sending us a secret-coded message, E-Trade is, to get out of the market. So yeah, I think that's it. When people are overconfident and they think that there's no other way that it can go. So you go back to real estate in 2006, you talk to people, they say, real estate can't go down. And you ask them, what do you think is going to happen to your real estate in the next 10 years? 9% a year, it's going to go up. That's the time to get out. Okay? When everybody agrees on something, that's when you've got a problem.
I think I have time for a 30-second question. Is there an anti-bubble? Does it work to the downside?
Fear. So behavioral finance is sometimes called fear and greed, economics of fear and greed. And so when fear is rampant through the landscape, when everybody in 2009 is thinking, I've got to get out of my portfolio because I can't afford to lose any more, that's the time to get in. So again, when everybody is saying, we're going to hell in a handbasket, that's the time to buy. Generally, but of course, sometimes things are down for a reason. So you really have to know the fundamentals first, and then look at what you think the price is relative to the fundamentals. So you really can never abandon pure fundamental research as to keep you grounded. Okay? All right, thank you so much. It's been great. I enjoyed talking to you guys.